My name is Jan Heitzmann. I'm managing the director of Correggio Consulting that has also a branch called Correggio Net, managing at the end regulatory challenges throughout the European market space. And we have 3 speakers, so we'll have 1 hour to spend. All 3 speakers speak about similar but different approaches when it comes to credit exposure management. And the first speaker I would like to introduce you to is Insa Antipova. You are looking at her already. She is smiling at you. And she will talk about regulatory framework and market developments, and also have a very entertaining slides for you. So you don't need to be fear to the completely bored. I think you will be adequately entertained. Then things are getting a bit more difficult when Nick Jackson will join us, CEO of Griffin Markets. He has also important information to convey on credit exposure reduction service. That is something that he will further enlighten you on. And the really tough one will be obviously the one at the end, Hugh Brunswick, CEO of Equias. They will talk about bilateral margining in practice. And at the end of that hour, or towards the end, we will have some discussion, also Q&A. So please use the chat for the Q&A. We will not have otherwise the possibility to have questions because we are expecting too many people in this seminar. And so use the chat. We will then collect it all, and at the end we will discuss the questions that are in the chat. So please, the invite is there. And with these introductory remarks, I would like to pass the baton to Insa. Please, Insa Antipova.
Hello, everyone. So first, thanks for joining us for this seminar. And it is a pleasure. It is a pleasure to present this topic with our partners, with Griffin Markets, with Equias. So as Jan promised, indeed, we will try to be as entertaining as possible. And although I'm a lawyer, don't think that my presentation will be legalistic and boring. I promise that it's going to be quite interesting for you. So just a second. Yes, so I hope you can see my slides, correct?
Yes, all fine.
Okay, so about the speaker, so that's actually me. I have 18 years of experience in the energy sector of Ukraine and in EU. I worked for a long time in a law firm, then I worked for a long time at NG, and now I'm with Correggio. I'm director of legal consulting at Correggio Consulting. So you may understand that I'm a lawyer indeed, but I also combine experience of in-house and consultant. So be sure that our advisory services always remain as practical as possible. So what about Correggio? In Correggio ecosystem, we have 3 companies. It is Remitrap, Correggio Consulting, and Correggio Net. Just a few words about each of every company. Remitrap, this is a company which provides for representation services for non-EU market participants at the energy market. Now it provides not only Remit 2 services in Europe, but also the services in Switzerland for Swiss BAIT. We have a new company and a new service. Correggio Net, this is a company which provides standard services for market participants, helping them to remain compliant with their regulatory obligations. And finally, Correggio Consulting, this is a company who offers you tailor-made consultancy for energy market, for compliance, for market access, for trainings, for contractual support, and a broad range of other services. So a closer look to Correggio Net. Correggio Net is a regulatory technology platform which was founded in 2017, so almost 10 years ago, to support energy trading companies. And what we do, we help the companies to stay compliant with their reporting obligations. So you can see that we cover 34 jurisdictions. This is a huge regulatory base which helps you to not to forget about your reporting obligations. We have major companies using our services and smaller companies using of our services. And in a nutshell, I can say that we make compliance managers happy. of these companies. But one day we thought, okay, we make compliance managers happy, but what about other operational teams? What about other colleagues? We should also make them happy. And we came with a solution, indeed. I will tell you about this solution a bit later, but now we should actually think about credit exposure. And to understand the credit exposure, we should remember the payment netting. This is a simple thing that is familiar almost to every single lawyer or every single credit specialist or back officer. So without netting, your risk is huge, and with netting, your risk is small. This is in a nutshell. Payment netting is when all the values, all the transactions, unpaid amounts are reduced to a single net amount, and this net amount is owed by one party to another. So quite simple, isn't it? Okay. So, and what is the reference with the master agreement? Payment netting in OTC agreements, in IFETs or in ISDA, this is actually a single agreement concept when all the transactions are tied together as one chain and they are linked under one master agreement. And under this master agreement, or maybe under a few master agreements, if you use master netting agreements, they all come to one net amount. So that should be quite convenient, isn't it? What do you think? And this is exactly how the credit risk is calculated by our credit officers. So in a nutshell, every day, credit officers asks, what would you have to pay me if we terminated the contract today? And in this case, it is very important to remember that sometimes netting is enforceable in one jurisdiction or non-enforceable in another. Especially important this is when we deal with insolvencies that happen very suddenly, very unexpectedly, and then within days, if not hours, you should actually calculate your termination amount and understand what is your credit risk. So this means that credit risk exposure is actually something very closely linked to closeout netting. So the main question, you remember Shakespeare always asked to be or not to be. Yeah, that was the main question. In energy trading, we have a bit different question. The main question is nettable or not. And in this case, we should look at if the product is nettable and if this product is nettable in this particular jurisdiction. Because their insolvency rules and their enforceability rules may differ from one jurisdiction to another. And there is a huge plenty of different regulations that you need to look and legal opinions that you need to check. So in a very, very nutshell, you can see that your credit team, when netting does not work in this jurisdiction, your credit team looks like that. So not a very promising and not a very optimistic picture, isn't it? When netting works in this jurisdiction, your credit team is absolutely calm, in inner peace, happy, and delighted. And in the meantime, what happens with your legal teams? Do you know how many pages your team have to go through until this question about nettable or not is replied? So actually the reply is that you need to read hundreds of pages of legal opinions for different jurisdictions, for different products. These legal opinions are, of course, available. They are prepared by law firms, they are prepared by specialists, and they are written in a very complicated language that honestly, not everyone can understand. Even us, lawyers, we sometimes have difficulties in understanding what exactly is meant by this or that legal opinion or this or that wording. And each and every one of us spent hundreds of hours, hundreds of days reading these opinions and trying to understand actually if we can report to the credit team that something is nettable or is not nettable. So that's you can understand our pain here. So, and usually the problem is that usually you don't have this time. When insolvency happens, you have only a few days, if not hours, to reply to the questions of your credit team, if this is something that we can net or not. Of course, the best practice is to check this in beforehand when you sign the IFET agreement or the OTC agreement. But in reality, People always forget to do this, or they don't want to read these hundreds of pages. So the problem happens when the insolvency comes. But what if your legal team actually could have some help? What if your team had help and you ask nettable or not, and you receive a reply in seconds? Would you like to have this solution? I think that for the most legal persons and for the most legal teams, their reply would be yes, we would like to have this. So we have this solution. This is exactly the solution that should make you happy. This is Colla, Correggio Online Legal Assistant. This is an AI tool that makes it easy to understand contract rights, netting protections that are available to you in this or that jurisdictions, and legal risks in gas and power trading agreements. So what is actually Colla? Colla is an AI chatbot. So you can talk to this chatbot just in the way you talk to ChatGPT, or you talk to Claude, or you talk to your favorite AI assistant. And you particularly ask, what should I do to net the commodities for my IFET agreement in this jurisdiction? And Colla replies to you in seconds, saying that, okay, now you can net if you make these amendments to IFET agreements, or you should be aware of this and that protections, or you should be aware of this and that restrictions. Quite interesting, isn't it? So probably you want to see it. So we have a small demo here. So this is how Colla looks like. This is the chatbot. You see here, you may have new dialogue, search in dialogues, you may have your favorite, you have actually the window where you print the question, but you also have some questions that you may ask just to check. So this is a video, so you can see how this works in reality. You ask a question, can automatic termination be relied in Austria? You see, it is asked in a very simple way. And this is the reply. So you see reply comes in seconds, and it comes with detailed analysis, with a short reply, with detailed analysis. You can see the opinion date, you can see recommendations, you can see the wording that is recommended. And what is even more important, you can see the exact source. You can see where this comes from. And where does this come from, you ask? So the reply is that we produced our own legal opinions. We asked our partners and the law firms from different jurisdictions to produce these opinions for us. So this is a absolutely reliable document that you can see in Colla, that you can read and you can check in PDF. And Colla cannot hallucinate. Colla replies to you only if this is in Colla's database. So this is something that really makes a difference with ChatGPT or other AI assistants, where they can create some illusions or they can create some information. In Colla, that's not possible. We tested months and months to make sure that Colla only relies on something that is in Colla. And be sure that all the information that you provide to Colla is completely confidential, because it is not shared to any third parties. This is you for Colla. We use only our services, so the information doesn't go anywhere. So what Colla can do actually? Colla can reply in seconds to a number of questions about your OTC contract. Currently, this is mostly about IFETs. Colla can check netting enforceability. Colla can tell you if your product, if your commodity is in netting for this particular product is enforceable in this jurisdiction or not. Colla can spot key legal risks in your IFET agreement. Colla can tell that you need to make this amendment or that amendment. And Colla can also recognize when additional input is still required. So Colla will tell you if you ask a question that Colla cannot reply, Colla will tell you this. What you can do with Colla? You can ask legal questions about standard agreements. Currently, this is IFETs, in a very plain language. So is it enforceable? Can I do this? Can I net? In a very simple, you don't need anyone to translate. You don't need a legal person actually to translate this. You can get clear, accurate answers in seconds. You can access legal analysis instantly. You can literally see the PDFs. You can see the legal opinions to check. And you can use also practical guides on standard OTC energy agreements. So this is also one of the most wonderful things that we have in Cola. So what jurisdictions are covered currently? You see Austria, France, Germany, Hungary, Italy, Netherlands, Poland, Spain, and Switzerland, but more jurisdictions is coming. So in a nutshell, you will have the cover for most of your counterparties, and you will be able to check what amendments you need to make to EFED. We are currently working on adding more jurisdictions. This will be probably UK and also for Slovakia, where there is a new law, a new regulation about netting. So this is something that is coming. Stay tuned, so to say. So what is included in Cola services? First, this is actually the Cola chat that I presented to you. This is AI legal assistant who will deliver the guidance on EFET agreements to you. We're on the basis of the legal opinions that were procured by Correggio and that are updated regularly. And this is also something that really makes a huge difference, because you cannot rely on something that is on a legal opinion that is dated 2022 or 2023. You need something recent. Just like with Slovakia, if something was adopted by the Slovak government last year, you want to know this and you want to be sure that it is already in the legal opinion. Cola service, Cola Brain, this is actually a full toolkit in PDF. This is netting matrix, this is practical guides. This is developed by practitioners and for practitioners. So you can be absolutely sure that you will have practical guidelines, you will have practical checklist how to negotiate and how to implement your EFET agreements. And finally, you have this is a magic tool, Cola Hotline. So in case that you doubt about Cola's reply, you want it to be double checked, you can press a button which is called Cola Certify. And Cola Chat answers will be reviewed by us, actually, by Correggio experts who will tell you if Cola's reply are correct, if there is anything else that you should know, and we reply very quickly. Usually it takes one, 2 business days. So you may rely on this. So why this matter actually for your business? Because with Cola, you will receive faster answers, you will receive better risk management, and you will be more confident in your business decisions. So eventually, this will result in lower costs and time commitments and instant practical guidance. So actually, your performance will improve. So we will be happy to provide you with access to Cola. For now, we understand that you may want to try before you pay, before you say yes to the dress. And that's why we offer everyone to have a test period free of charge for 2 weeks when you can obtain access to Cola and check and actually give us feedback if Cola is as good as we present. So thank you very much. Please feel free to get in touch with us. We will be happy to provide you with access to Cola. And we hope that Cola will make you happy because this is our primary goal. Thank you.
Wonderful, Insa. Thank you very much for this. Very smooth. We'll be now moving on to Nick Jackson, CEO of Griffin Markets, that will talk about credits. So he's already here. Hello, Nick. I pass on to you, please. You have to compete now with Insa, so. Nick,
yeah, tough act to follow.
In terms of entertainment.
Thanks, Jan. Hopefully you can all see my slides here. Hi, I'm Nick Jackson. I'm the CEO at Griffin. And just really wanted to talk about some credit optimization solutions that we offer. So Griffin, if you haven't come across us before, we are an interdealer broker, and we operate through a hybrid OTF platform, specialising purely in energy, and largely thanks to Brexit, we have offices in London, Paris, and Milan. And alongside our main brokerage business, we do offer some ancillary credit reduction services, one of which is a monthly credit reduction run, which operates through an online portal. And the second is through a preferred sleeve system, which we use when we're arranging sleeve trades. And just wanted to outline those very quickly for you this afternoon. So, firstly, the credit optimization monthly runs. As I say, these operate through an online portal. It enables people to upload positions or exposures that they want to reduce. We then use that data to create and execute rings of triangulation trades. And I think I'm right in saying that the record number of companies we've had in a ring so far is 9. So anything from 3 to 9 at the moment. So on the slide that you can see, that's a screenshot of the portal. You can see, so this is the view of a user of the credit team, and you can see companies, your counterparties, effectively down the left-hand side, and then across the top, you've got a list of TTF contracts going out from balance a month out to the quarters. You can upload your data against your chosen counterparties using a standard spreadsheet, and you can do that in either euros, megawatts, or megawatt hours. If you enter a short position, meaning that you want to buy, that number then appears in a green box. A long position appears as a red box. And there's also actually a neutral one that's not on this screenshot, unfortunately. That's a blue box. That's a neutral position, meaning that you're happy to buy or sell to that particular counterparty. You can also see when data's been entered against you by your counterparts, and you can see company E there has entered data against us. And you can see where you've got a match and where you haven't got a match. And if you look at the current month for company E, you've got we've got a short position there of -63, but you've got a red cross. And what that means is that company E also has a short position and wants to buy. So we don't have a match in that particular instance. But if you look at company D in June, you can see we've got a green tick against there, meaning that we've got a long position, they've got a short position. So potentially that's the beginnings of a triangulation ring. If you haven't entered data against someone, but they've entered data against you, you'll get a question mark, and there'll also be a letter next to it to show you the direction of the interest against you. So again, if you look at DRW there, they've entered data against us, we haven't entered data against them, and we've got some question marks and an S, meaning that they would like to sell to us. You'll get the direction, but you won't get the volume. You can do this for cleared trades as well, so you can effectively do EFPs through this process. You can do cleared and bilateral. And if you want, you can group companies into different groups. So you can do what some people do is do CSA and non-CSA in different groups. So you keep those companies completely separate. So once all the data's up, we generally open the portal about 2 days before we do the run, and that allows time for people to upload the data and see what's coming in against them and start to tweak their submissions. So on the day of the run, we'll close the portal around midday, and we then run our algorithm, which will calculate the optimum number and group of triangulation rings. That takes just a few minutes, and then once we've done that, we'll publish all of those trades that have emerged from those rings, and we'll publish those perfect matches to each counterparty. You can see your own trades, but obviously you can't see anybody else's. And then what we do after that is we run what we call a series of workups. And I guess the purpose behind that is to make use of the leftover data. So you can imagine there's lots of data in there that's gone to create the perfect matches, but there's an awful lot of other data that's left behind. And what the purpose of that is to try and see if we can make any more triangulation rings. So, for example, there's a missing link workup. So if we managed to almost create a a complete chain and there's one missing link, and that missing link involves you, the system will send you a message saying, if you want to take this trade on, we can complete a triangulation ring, and you've got the option whether or not you want to accept that. There's a volume bottleneck workup. So if we've got a ring, and let's say all the counterparties in there, except one, have said, yeah, we're willing to trade 100 megs, and one counterparty said, well, I just want to do 25. We'll go to that counterparty that's said 25, and we'll say, actually, there's an opportunity here to do more volume if you want to do that. Then again, you've got the choice of doing that. We'll also highlight priority positions for you, so you can identify priority positions, and by that I mean positions that you're particularly keen to reduce. And if there's an opportunity to reduce one of those, but the trade on the other side may go against your stated preferences, that option will be presented to you. And again, it's up to you whether you accept that. So the workups run afterwards, and that process runs for an hour or so. And once that's been completed, we'll then execute all of the trades in the usual way. Bilateral trades go through the OTF and therefore benefit from the C6 remit carve out, and any cleared trades are given up and executed on the relevant exchange in the normal way. And so that's the monthly run. That I say runs on a oddly enough on a monthly basis around settlement date. And at the moment we've got a community of around 30 companies that take part. Normally, because of holidays or staffing resources, you could get about between sort of 12, 15, 20 people take part. And obviously, the more people that take part, the better. So, hence why keen to give this a plug so that we can spread the word amongst the community and make this really beneficial, really for everybody. Outside of the monthly runs, we also run a preferred sleeve service, and this obviously operates all the time, and this operates when we're trying to arrange a sleeve. So we ask our customers to provide us with preferred sleeve data, which is very similar to the credit reduction data we've been talking about. So that when we're looking to arrange a sleeve trade, rather than going to random counterparties saying, will you sleeve this trade for us, we can actually use the data you provided to identify counterparties who actually would like to do that trade because they may be able to reduce their credit exposure on one or even both sides. So that's a great way of introducing credit optimization into the normal process of trading. Now, one comment we often get from credit teams is it takes an awful lot of time to pull together all the data to submit to our credit reduction runs. And I guess over the course of the last few months and years, we've been talking to iPushPull, who have been developing their own credit optimization tools. And actually, we've come to a point where we are looking to collaborate with them so that they can help credit teams by effectively pulling data from ETRM systems and creating credit exposure reports, which can either be automatically sent straight into our system, or it could be sent to a credit team to review that report and then decide what to do with it, or whether to action it at all, or whether to send it on to our system. But the main driver, the main purpose behind this particular service is to reduce the time, make that process more streamlined, so that credit teams can very, very quickly and efficiently arrange the data that they need to submit to credit optimization runs like the Griffin one. Andre Montoyano-Himes is the guy to speak to if that is of interest to you guys. So that really brings me to an end. I just wanted to be fairly swift. Draw that to your attention if it's not a service that you come across. and also, like I say, to spread the word, because the bigger that community, the better for everybody. So thanks for listening. Thanks for listening, everybody. And back over to Jan.
Thank you so much, Nick. You are so much disciplined in time, perfectly on time. So Hugh gets now the floor to talk about bilateral margining in practice. Hugh.
So yeah, thank you everybody. Thanks to Nick for sort of setting up the view from the front office perspective, from the execution perspective. What I'm going to look at is more of a fundamental post-trade processing perspective in order to address fundamental calculations of bilateral margining and exposure through the middle and back office on an industry-wide basis. So I've entitled it Essential Exposure Calculations and Bilateral Margining. What I'm going to cover is a quick look at the price shocks in OTC, look at Equias's industry data role. Now I'm going to look at volumetric exposure, which is an artifact of the new Remit 2 legislation. There's quite a good setup for the financial exposure calculations and mark-to-market calculations that we're going to be looking at in the context of bilateral margining. And then we're going to look at automated bilateral margining itself and draw some conclusions. So if I can get this to work. Yep, here we go. So I've got a chart here. It's always good to start off with a chart. So as you can see, it goes from January 2019 through to end of March 26. And what it shows you is the percentage year-on-year growth in OTC transaction volume as represented by confirmed trade volumes. So if you like, the July 1919 was growing around about 30% year on year compared with July 2018, for instance, and so on and so forth. So it shows whilst we're positive on the positive side, while the percentage of positive, that's year on year growth, and obviously when it goes negative, that's year on year contraction in trade volume as represented by monthly aggregate confirmations. Processed through Equias services. You'll notice that the majority of the time it spends its life above in the growth space, but there are certain events, which I think you can probably guess, which are where you see the market contracting. So it contracted a little bit in COVID. It contracted a lot as a consequence of the Ukraine. You can see 60% year-on-year contraction. And into March and April, it was contracting again due to the Iran conflict, presumably. The good news, I suppose, is that it always bounces back. So you can see it always comes back and tries to reclaim the territory that it lost during the latest crisis. So it's resilient. I think you can say the OTC market is resilient. So why is it resilient? Well, a look at the TTF and THE gas contract trades for the May 26 contract, and this was a snapshot taken from trading volume at the end of April 26. You can see that both the markets, both the contracts, if you like, the TTF and the THE are rather similar. You've got a similar number of brokers, exchanges and participants active in both. But there are obviously some fundamental differences between how each of the contracts are traded. So here on the TTF, nobody's surprised to find out that the exchange is definitely dominant in trade count, and the notional volume in megawatts is also the largest number. If you look down at the THE contract, the opposite is true in actual fact. The OTC contract, the broker contract, is the larger contract, and you'll see that even while we're looking at TTF, that the actual notional volume, even though the transaction volumes are smaller through the brokered OTC route, the actual volume which is transacted is not in the same proportion. It's not that much smaller than the number of transactions, indicating obviously that on exchange are doing a lot of tiny algo click size transactions going through. So the OTC market is the natural home, I suppose, for asset-backed traders, and it's where the volume really changes hand, even if the price and the dominant benchmark contracts on the exchange are setting price. Okay, so that was the point I was really trying to make, just to set it up, to give you an idea of what the data tells us about the OTC market and its resilience and its weaknesses. So what is the role of Equias? Well, if that is a drawing which it tends to show the chaotic state of the OTC market, it's not really chaotic, it's just a network of bilateral relationships. But each of those relationships are unique, they're standardized under a master agreement, but obviously they all depend on a bilateral relationship between the two counterparties. What Equias does is really sit in the middle of that whole bilateral environment and standardizes the way the post-trade processing is conducted. So it standardizes the data formats and it standardizes the processes and calculations. So Equias is Europe's largest post-trade automation service provider, and every day as Europe's largest regulated reporting mechanism, that's an RRM under remit, we in actual fact collect all the OTC orders and trades executed on broker venues and all life cycle events for most of the bilateral and off-venue trades as well. So we sit on a lot of information that's flowing through that bilateral market, an OTC traded market. We'll move on to central calculations and why they're beneficial. I'm moving fairly quickly through this. We'll have some questions at the end. I would summarize the benefits as the fact that it covers the whole market. Obviously, there's somebody in the middle doing something for everybody. It covers the whole market. You don't have to wait on the counterparty to do something. It's done for everybody centrally. It also standardizes the formats and calculations, so it makes data and documents matchable. For instance, the confirmations, it standardizes the regulatory reporting and invoicing and so on and so forth. We can do that for the margin calls too, as you'll see. Valuation prices, where calculations are made using price, are also against a reference third-party price. There's no disclosure of internal prices when it comes to calculating exposures, for instance, and it facilitates collaborative discrepancy identification and reconciliation. So you've got a common service which both parties have access to see and resolve any discrepancies associated with the calculations which are performed. It happens in confirmation matching and invoice matching, and obviously it can happen in other matching services such as margining. We're already going to be implementing central calculations for volume. Volume exposure reporting is a legal requirement under remit, and we'll be calculating as part of the remit 2 go live in 26 and 7. We'll be calculating the exposure, volumetric exposure of all parties reporting through our RRM, and that's around about 4,500 participants whose reported data travels through our RM. So we'll be generating daily volumetric forecasts effectively, which are needed under remit, which people can reconcile against, and obviously they can become the basis of the exposure report going forward. And that is being developed, as I say, in conjunction with the rollout of remit 2 over the coming months. In parallel with that, we're going to also not only calculate the forward-looking open exposure for volume reasons, but we're also going to calculate the daily M2M, so the mark-to-market, and that obviously is the fundamental basis for the calculation of bilateral margin and margin calls under the CSA arrangement. We're doing it for two reasons. One is that in conjunction with the volumetric calculations which we're producing, which need to be reported to ASA, it also provides a sensible reconciliation yardstick for people to determine if what they've reported is what they're really calculating and managing through their internal system. So it's a financial yardstick as opposed to a volumetric yardstick to measure your compliance with your obligations under remit, if you like. You can compare the two together to see whether they're similar, and therefore be assured that what you're reporting is what you're working on and in line with your obligations under the law. But also, obviously, outside regulatory perspective, it's the basis, as I keep saying, of something bigger. I would say something which we're calling electronic bilateral margining. So how does electronic bilateral margining work? How can we calculate your exposures and your counterparty's exposures? Well, we have the OTC data. It's reported, as I said, through Equias' RM. So it's effectively a legal obligation for everybody to report that data, and all the venues, all the OTC venues report through us, and a majority of you also report through us for your bilateral transactions, both your standard and non-standard. So we already sit on the majority of the bilateral markets order and trade data. We therefore are able to combine that data with cleared information, say market data from exchanges that we buy in, to create a very complete set of market data, which combines cleared OTC and bilateral price data through on a trade-by-trade basis and order basis for anything which is executed on venue. So we have the elements which allow us to bring together a client-specific position with probably some of the best prices the market can produce in actual fact, in order to calculate a mark-to-market. And together with client-specific parameters like thresholds and letters of credit and so on and so forth, which are maintained by the client, we can calculate we can calculate the mark-to-market and therefore generate a match of margin calls between counterparties. And obviously that is then passed through a matching capability, and any resolution, any discrepancies can be identified and resolved between the parties, as they would be through a confirmation match or an invoice match. So that's the basis of the way that bilateral margining can work. This is what a call document generated by the service looks like. You can't really see that in any detail, so I'll give you a bit of a close-up. So there's a calculation with exposure, it has a threshold independent amount, it has the cash held by the counterparty, which is rolled over from the previous event, any pending movements which are in flight, letters of credit provided, and its securities. And obviously the calculation is the difference between those, and there it is down the bottom at 10 million, which is the call from this counterparty to the other. The data underlying that is obviously the contract details and then each of the transactions in that contract, whether it's a buy or sell, whether it's long or short, whether it's the traded volume and the price variation. We also simulated what a bilateral margining scenario would look like. Here we've created a situation which there's a counterparty which has, well, 1, 2, 3, 4, 5 counterparties which it's offering a line of credit. Its credit in aggregate is signified by this line, and then as the market price rises, you can see the comparison between how the exposure grows on exchange with the initial margin included, and how it grows in a bilateral relationship. So as you can see, the credit line is exceeded by the exchange quite early, but that's okay because you've got an initial margin in there, so the credit line is taking up the initial margin, and the gap between the increase is the variation margin. Therefore the bilateral variation margin tracks the exchange calculated margin because it's using the same exposure price. But what you can see is that at no point in this scenario, and this uses a prices from the market, at no point during this scenario did the a total aggregate exposure of the underlying counterparties exceed the aggregate credit line of me, the counterparty, from whose perspective this is being calculated. So the point of this really is to highlight the fact that bilateral margining has some major benefits. because physical OTC markets are, we would say, the natural home for asset-backed participants. Credit lines save initial margin, but are sensitive to price shocks, and innovative brokers, in the form of Griffin Markets, for instance, are optimizing credits around the execution side of the business. But what we're looking at is really how to automate bilateral margining as a fundamental industry service, really, in order to mitigate the need to shift positions to exchange in times of crisis. Also to optimize cash utilization by freeing up cash which would otherwise be tied up in initial margin, and obviously retaining liquidity in forward physical contracts where the majority of physical volume is actually traded. So next steps in our initiative is really to, during 26 and 27, is to develop the central calculation functionality, which we're doing as part of the remit exposure reporting process. So we're committed to doing that to specific timelines, and it'll go live in September 27. The bilateral margining is a discretionary development, but we're developing that because we believe that the industry needs it, and we'll be developing it in parallel with the remit functionality for exposure reporting, and we'll be opening a work group again. We ran a work group a year or two ago to do the basic work on this, but we'll be reopening the work group for interested parties during 26 and 27. And that was it, really. It was just an opportunity to get it out there that we think there's a fundamental way of improving the way that the OTC market works. We see the evidence. We've had the experience of going through 3 price shocks now, and it's a wake-up call to do something about this problem and create more integrity and robustness in OTC markets. So that was it. Over to you, Jan, and anybody who has any questions.
Yep. So nobody has used the chat function. But yeah, why don't you come out if you have questions to any of the 3 speakers, so that we can discuss this a little bit. Obviously, hopefully, Hugh, these wonderful offerings bring some, let's say, trades back into the OTC market, because I think too many of that landed in the exchanges. So maybe because of this offering, this trend can be reversed. So where then do people need to write to for your working groups that you just advertised? Is there anyone particular that they need to approach? Is it yourself?
I mean, obviously, support at equias.org is always the place to write to, or to me personally, h.brunswick@equias.org. We will also be running several remit workshops, but also road shows around Europe, which we do every 2 or 3 months, and so we'll be visiting somewhere near you probably over the coming months, either to talk about remit or to simply talk about Equias and issues like this. But yeah, my details are on the slides if you're interested. Obviously, just let either the support team or myself know.
I mean, as far as Cola goes, obviously the same is true. We have tested extensively the Cola service. More than 20 companies have been in working groups to test this facility, and we are now, I think, comfortable with the outcome. Is there any question to Nick or Insa, Hugh, anything? We have 10 minutes left. Anyone, anything? Or is it just too hot?
Yeah, why do you think the bilateral margining is not adopted currently without somebody calculating those amounts centrally?
Oh, you know, sometimes in this industry, you wonder why solutions are not, why problems are not solved. The answer probably lies in overcautious managers. They don't want to enact into new processes. There's also many details that have been not been properly solved, like things like rounding that should be a long time resolved, but is still not really resolved because different people round differently. Also, the credit group in EFET has done a great job in trying to streamline an industry practice for everyone to adhere to. The problem that you have is that all of that is voluntary. So ultimately, if the companies don't want to join, they do their own thing, and as long as they get on with it, they get on with it, and that probably is the answer or the underlying reason why these things haven't been solved. But I think it's a great project that you're having there, and there should be interest in it because ultimately trading everything on the exchange brings so many costs with it. It's very expensive trading, so ultimately you haven't talked about money. Is it something that you want to talk about, Hugh?
I mean, I think it's all about money, really. I think liquidity will be drawn to where it's cheapest to execute, ultimately, if the risk profile is similar. So OTC should be the cheapest place to execute. And you can see, because in large volumes, people do it OTC. They don't go onto exchange to execute the large volumes because the data shows that. And for obvious reason, because the initial margin is so huge. So it is the place you go. The issue is the other side of the coin, which is that you haven't got the robustness or integrity, because every time there's a price shock, obviously, credit lines get stripped out and people have to move positions into clearing in order to mitigate the credit risk which they're carrying. It seems so stupid when you've got a whole CSA arrangement which has been developed as part of the standard bilateral contract arrangement under the EFET terms. Everybody holds these things. It's quite easy to execute, or should be quite easy to execute, a CSA annexed to the standard master agreement. For legal framework sitting there just waiting for people to employ it. So it can only be the operational business of making these calculations and resolving the communication and matching process, which obviously Equias does for a living and has done for 25 years. So for us, it's really quite a straightforward thing to calculate and do. The question is, why would people not do it and sleep at night? You're then living in an environment where you've got cheaper execution, you've got a similar risk profile, and everybody in the industry is your counterparty. Their exposures can be being centrally calculated on their behalf. So what could be better, I suppose? Absolutely. We have a question here from Eric. I don't know what it is, but please... floor is yours.
You're muted. Hi, thank you. I just unmuted. So thank you. So how do you handle customized initial margin because under DMA arrangements? And secondly, what if your CSA includes, like for instance, under a master netting agreement, includes other things besides European gas? How does Equias incorporate all of those things into the daily margining?
It would only be able to automatically calculate the transactions that are passing through the regulatory service, effectively, because we take the data out of that because it has to be reported anyway. So it'd be confined, unfortunately, to anything which is executed on an OTC venue and reported under remit. So it's restricted to European electricity and gas and obviously Swiss electricity in due course. So it has that limitation. It doesn't exclude additional transaction outside of that scope being uploaded, but then that would be an obligation on the parties involved, and that's where it starts to break down a bit, because then you're dependent on the other counterparties also making that data available, unless Equias can go and collect that from the exchange or from the DEA. So we're quite happy, and we do go and collect data from other locations. For our trade monitoring service, for instance, we actually read the private order feeds off exchanges, so it's not impossible to aggregate and access data in other markets. But out of the box, we've got the electricity and gas, European electricity and gas markets. Anything else would require additional data aggregation, basically. But the principle's the same. We can read in the the trades, and we can do the calculations. That's not the problem. We've got access to the data. We've got oil data. We've got emissions data, and so on and so forth. Which, because we cover off that for trade monitoring purposes, so if we can have your trades, we can obviously do the mark to market off that too, but we would need the counterparty's data as well in order to conduct an end-to-end calculation and match.
Any other question?
Or did that answer?
Jan,
Yes.
if I may interrupt, I think we have questions in a Q&A chat, and yes, and we also have one more question in Teams chat. So let me start, please. So the first one is from Ileana.
Yeah.
Yes.
Right.
The first one is in the Q&A chat from Ileana. Do you have any information about Acer's requirements regarding REMIT 2 and exposure reporting templates, etc.?
We do. Quite a lot of that. It's quite a hot topic. Probably this is not the forum to discuss that, but if you want to contact me or through support@equias.org afterwards, very happy to inform you all about that. And I'll actually be talking about it next week a week after next in Budapest at the ETSI conference as well. But please do contact me directly or the company.
There's a question for you, Nick, there. If more companies join for credit optimization runs, does the complexity of matching preferred sleeve data increase, or does the larger pool make it easier to find offsets?
Yeah, in short, it makes it easier. The more data we've got, the better. Then we've got more choices and more permutations to look at. I can see why the question's been asked, because if you've got so much more data in there kicking around, the algorithm's got to work harder. But ultimately, yeah, it makes things better.
And we have one more question from Kotamis. As PPAs increasingly involve active management of imbalance risk through OTC energy trading or bilateral arrangements, how is this influencing the way parties approach collateral, margining, credit support, and risk allocation under the PPA?
To whom is this question to? Is it who would like to answer this? I mean, maybe we'll just, Hugh, could you answer this? I mean, I don't think there is a particular approach, but maybe you have an idea for PPAs.
Not really. I have to admit. I'll just read the question again. Tell me if that's quite a complicated one. How is this influencing the way parties approach collateral, margining, credit support, and risk allocation under the PPA? Yeah, I don't think there's a simple answer to that, probably. The only thing I could say is that in terms of exposure reporting and volumes, the good news is that it's quite easy to understand what the volume is that needs to be reported under remit. And when it comes to financial exposure, it's a lot harder, obviously, with these complex PPAs, because pricing is a nightmare. Obviously, it's very hard to centralize that. So in terms of financial exposure, it's only really possible to mark to market standard trades. It would be very difficult to mark to market a PPA. I don't think that's really what Katamis is looking for. He's looking more about the whole framework for credit risk mitigation that surrounds the OTC trading off the back of a PPA contract, which I think absolutely makes sense, because the PPAs are really just they're like virtual power stations, aren't they, or equity gas if it's a biogas or whatever. So they're just assets which people will trade around and optimize, just as people used to do that with thermal plants, and obviously still do in some cases.
Anything to add, Nick, from your end?
Oh, no, nothing more from me on that one. No, I think Hugh's encapsulated that.
Okay, thank you, ladies and gentlemen. Thank you to the speakers for this workshop. Hopefully we'll have other ones to follow. We're just on the minute done. The hour is fully filled. Thank you for the entertainment, Insa. Was brilliant, and have it all to you. Wish you a good afternoon. Bye-bye.
Thank you. Thank you very much.